welcome back to All Things Money. I'm your host, David Blain. During today's show, we're talking about some timeless investing principles that will serve investors just starting out to investors with multi-millions of dollars very well. These are principles that have applied throughout the ages, and we hope that you will heed them well. If you happen to miss the first couple of segments, head on over to our website, which is www.dlblain.com. There we post archives of all of our TV and radio shows, as well as some other very interesting articles that we have either written ourselves or been interviewed and published in various publications. So before the last break, we were talking about an investment theme that permeates all of them, which is to be patient and focus on the long term. Individual companies generally recover. I say generally, they don't always, but markets are much more resilient. And if you're diversified, they always recover. That if you had all your money in, say, the German markets before World War II, well, you would have been wiped out, or Japanese markets. And so we realized that whole stock markets can also come and go, not that often, generally not overnight. And so we encourage you to be broadly diversified over various asset classes and don't overemphasize one over the other. But the most important thing is being patient and waiting for good investments to come along and not overreacting to short-term news. And one of the things that I'll say that is an advantage over the average professional, the mutual fund companies and the firms out there that promote investment performance and, oh, we're better than everyone else and look at our quarterly numbers. The advantage that an individual and our firm has over this is that the patience, the ability to have patience, that mutual fund companies and these money management firms, they have huge, what I call career and business risk, meaning they can't afford to lose clients. And so if the U.S. stock market is doing 2% this month, they can't afford to make 1% because clients will leave them. Where an individual investor or a firm like ours that takes the long view and really, we look at those type of things, but they're not important in the grand scheme of things, the monthly, quarterly returns, is that we can have the advantage of looking at the long term, and we're not concerned if someone doesn't like the way we do business. Well, they're free to go hire someone else. Where if you're at these mutual fund managers, these people, their whole job depends on meeting these monthly and quarterly numbers and certainly annual numbers. And so they can't really afford to do anything different than the crowd because they can't afford to be different than the crowd. There's a saying that says it's better to fail conventionally than it is to succeed unconventionally. If you own just like in 2008, you say, oh, well, we lost 35% of your money, and well, that's okay because the market lost 40. That's what I call failing conventionally rather than succeeding unconventionally and saying, well, we didn't lose any money in 2008, but in 2009 when the market went up a lot, well, we only made, half of what the market made, but we didn't lose anything in 2008. That's what I call succeeding unconventionally. It's very difficult for the investment industry as a whole to do that. We think we do that very well at our firm by keeping the focus on the long term. For those of you out there that do it yourself, that is your advantage. Your advantage is not trading faster. Your advantage is not access to information. Your advantage is not finding something that millions of investment professionals around the world found. Your advantage is simply you don't have business and career risk in investing. You don't have to worry about getting fired if you have a bad quarter. You have the freedom and the ability to focus on the long term, and that's your advantage, and you should use it. In our firm, that's what we've tried to build around is clients that want us to use that advantage, that don't want to do it themselves, but want us to use that advantage over the other firms, is to take the long view. Look out, 5, 10, 15, 20 years, and how do you invest, how do you compound money over those types of time frames? And I'll tell you, it's not by day trading, and it's not by watching the news and trying to keep up with, CNBC. Okay. The next topic we want to talk about is another principle, is try to contain the natural optimism. And this is something that I work on all the time myself, is that I'm a naturally optimistic person, and I generally look on the bright side of things. I don't think the world is going to collapse. I don't think we're going to be going back to the caveman anytime soon. And so one of the disadvantages, especially in these bubbles that happened in 2000 or the real estate bubble, is people get over optimistic. And that's where principle number one, if you go back to that, and using history as a guide, if you find yourself being overly optimistic and you look at the PE ratios in 2000 that were an average of like 30-something, that's a little bit too optimistic when the average historical PE is somewhere around 15. When you look at real estate and people are doubling their money every 6 months, and you go back in history and look at, well, the average compounded rate of return for real estate has been about 3 or 4%, and you're doubling your money in six months, well, you should probably ratchet down your optimism, because that's probably not going to continue. At the same token, when those rare opportunities hit, like March of 2009, when everyone feels like the world is coming to an end, and stocks are trading at, I was talking about Bank of America the other day, people buying at 50 lost the majority of their money, over the past several years. But someone looking at it, for example, Wachovia, that's now part of Wells Fargo, they had preferred shares trading, 8% preferred, trading at like $3 par value. I mean, it was just an incredible bargain. And so having the ability, when the opportunities present themselves, to take advantage of them is one of the other aspects. So studying history, containing that natural optimism, but when the opportunities present themselves, try to be brave and take advantage of them. Well, we're running out of time, so I just kind of want to recap some of the advantages that the individual or a firm like ours has over Wall Street in general, is being patient and taking that long-term view. Those are the advantages you have: studying history, being patient, and taking advantage of the opportunities when they occur. Well, that's all the time we have. I hope you will join us again next week. So for All Things Money, I'm your host, David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.